Dealmaker March program. My name is Daniel Border, your current ACG DFW president, as well as a partner with Whitley Penn. We've got a fan favorite this morning with our family office panel. We'll hear how family office firms have navigated COVID, what the new investment models look like, and kind of what the future holds for them. Got a few housekeeping items to go over before we begin here. You all have automatically been muted and ask that you stay muted throughout the content portion. We also recommend that you watch in gallery view, which you can update in your top right corner of your Zoom window. If you have a question for our panel, please use the chat box function. The chat box should only be used for questions. If you have any other questions or issues, please send a private message to Brittany at ACG DFW. I'd like to take a moment and thank our programs committee who put this event together, and a special thanks to Dana Slinsky with Stevens and Mark Legrone, who you'll meet here in a moment. We appreciate all the hard work you guys have done for this event. As you know, we have high caliber members, and it's true reason we are here. It's my honor to welcome our new members in attendance: Phil Boyd with MB Connect, Nate Christensen with NJC Law, Scott Christensen with Christensen Law Group, Travis Haynes with Origin Bank. Welcome you all to ACG DFW. Also, we could not bring these outstanding content programs without the support of our sponsors. I'd like to take a moment to thank our 2020-2021 Dallas Dealmaker Series sponsor, Platinum sponsor, Calvetti Ferguson and Haynes & Boone, our gold sponsors, BDO, Insperity, Perkins Coie, and Winston Strong. Thank you all for your continued support of ACG DFW. If you are in a breakout room during networking with any of our sponsors, please thank them for their sponsorship. Speaking of sponsors, it's my pleasure to welcome Maria Hopper with Haynes & Boone to give an update on what they've been up to. Maria, I'll turn the video over to you.
Thank you, Daniel. Really appreciate it. We've been a sponsor to ACG for some time now, and we always welcome the opportunity to come here, participate, and contribute in any way that we can, and talk a little bit about our firm and what we've been doing recently. So as Daniel mentioned, my name is Maria Hopper. I'm a senior associate with the Mergers and Acquisitions Practice Group at the Dallas office for Haynes & Boone. And in addition to representing clients with selling or buying companies, I also represent them with venture capital, strategic, or startup investments. So your standard capital raise through the issuance of equity or debt-like instruments. And if anyone here in attendance is not familiar with Haynes & Boone, just in case, Haynes & Boone is a Dallas original. We are one of the largest law firms here in Dallas. In addition to our Dallas office, we have 17 other offices in the U.S. and abroad, including offices in D.C., New York, San Francisco, Shanghai, London, you name it. And spread through those offices, we have about 575 attorneys who specialize in various areas of the law and industries, including, real estate transactions, IP transactions, banking, finance, mergers and acquisitions, capital markets and securities, the list goes on. Because of our focus in those various areas and industries, we're able to represent our clients on a multitude of matters, but we're also always hosting CLEs and legal programs and writing articles and sending out client alerts on various recent legal developments and market trends. For example, with the recent Arctic blast in Texas, we now have a task force that is focused on this most recent energy developments. Also, we have recently published an article on recent case law in Delaware involving the use of third-party email accounts by outside directors and how that can have an impact on attorney-client privilege. Depending on that usage, you could have a potential waiver situation. So we have written an article on that. We shared that article with ACG I believe it's going to be available later today on their website during this month for all of the ACG members. So if you know of someone who is an outside director at a company, or if you have a company that has an outside director, it may be worthwhile taking a look at that article. It includes a few practice tips on what to do to avoid that waiver of attorney-client privilege. This is a very brief summary of the firm and what we've been up to. We are always happy to stay in touch and connect further. But with this, I will again appreciate the opportunity and turn this right back to you, Daniel. Thank you.
Yeah, thank you very much, Maria. We very much appreciate you and Haynes and Boone's support of ACG DFW. As you can see, sponsors are a key to our programs and bringing relevant and important content and networking programs to our members. If any of y'all are interested in the sponsorship of a virtual or in-person event, please contact Brittany with ACG DFW. Okay, I know you guys are all ready to get started, so here's the agenda. We'll begin with the moderated discussion, move into your questions that you've given us in the chat box, and then we'll finish with a structured small group networking subsequent. You can sit back and relax until we move into the networking portion. Once you move into the breakout room, you'll need to unmute yourself. So that's it. All right, now we can get to the program here. I'm happy to introduce today's moderator, Mark Legrone. Mark is a senior vice president at Bright Equities, a family office whose primary focus is acquiring controlling interests in platform companies that can be scaled by both organic growth and subsequent acquisitions within their space. Mark is also our family office director for ACG DFW Board of Directors. We are grateful for his support. Mark, I will turn it over to you.
Great, thank you, Daniel. And thanks everyone for being here this morning. I think we've got a great panel who has a wide variety of perspectives on the family office space, so I'm really looking forward to our discussion. I'd like to go ahead and get into it and introduce our panelists. First, we have Mickey McFarland, who's a managing director with Stevens Inc., where he is the head of family advisory services. We have Adam Lucas, who is a vice president with Concentric Equity Partners in Chicago. And Maggie Kipp, who is a partner at MJ Capital Consulting. And I'd like to give everyone an opportunity to talk a little bit about their backgrounds and some of the ways that they've touched the family office space, either currently or in previous roles. And so with that, I'd like to go ahead and start with you, Maggie, if you'd like to take a few minutes to talk about your background.
Hi, I'm Maggie Kipp. I'm glad to be here. Thank you to all our sponsors, and thank you to Bright Equities for inviting me to be part of this. I'm glad to be here with you all this morning. So I will be super fast. The business we have, after a long time, my partner and I have a long history in the family office world doing deals, me primarily in healthcare, her in all areas. We were asked about a year ago by some very large families here to bring opportunities that you wouldn't otherwise find in Dallas, things from the coasts, I guess we'll say, here to this market. So we're primarily growth equity, Series B to E. We're investing alongside Andreessen Horowitz, Sequoia, Amazon. We're on the cap table with them, Apple, and happy to tell you more about the things we work on, and happy to be here.
Thanks, Maggie. Appreciate that. And Mickey, if you wouldn't mind telling us a little bit about your experience with Stevens and some of the work that you've done working with family offices in your role.
Sure. Thanks, Mark. And thank you to ACG and the sponsors for hosting this event. First of all, I'll start with Stevens. We're a family-owned, middle market-focused investment bank. We're based in Little Rock, Arkansas, with offices all over the U.S., including Dallas is a significant presence for us, and then also in Europe. We are family-owned. Warren Stevens, a second-generation family member, is the shareholder of the business. His three children, Miles, John, and Laura, are all active in the business, and notably, John covers family offices in my group at Stevens. Lastly, the family also has a large family office investing platform that's affiliated with us called Stevens Capital Partners, which is focused on direct investing and partnering with operators in the private deal market. My coverage at Stephens is 100% focused on family offices. So we today touch about 200 family offices. 99+% of that group is focused on direct investing. So making private investments in private operating businesses in control and minority situations. That's it, Mark. Thank you.
Thanks, Mickey. And then Adam, if you could talk a little bit about your experience and kind of the perspective from the principal side that you have currently.
Yeah, absolutely, Mark. Thanks again, and thanks for the sponsors for this event. So I'll start with our firm. We are based in Chicago. We're the direct investing arm for the Staines family office. Staines family has been, the office has been around for 25 years, been direct investing in lower middle market companies, typically in control positions for almost 15 years now. We tend to have a regional focus on where we like to invest and where we like to partner with companies. So the family's got a long history in the west coast of Florida, pretty long history in Denver, and for about the last 5 years, a very strong commitment to investing in the Dallas-Fort Worth market. And it's personally relevant for me. I grew up in the area. My whole family is from there, from Dallas or from Houston. So I've been getting to spend a lot of my time the last few years with Concentric, coming down a couple times a month, building relationships, meeting companies, and we've made a couple investments and a couple more coming this year. So excited to be here and talk with everyone.
Great, thanks, Adam. And it's not usual that for this panel we get to have somebody from so far afield from Dallas, at least where their office is based, being in Chicago. Can you give us a little insight in what it's been like for the office breaking into the Dallas market, coming from a different part of the country?
Yeah, it's been really helped by relationships. Our firm is lucky that we have a 20-year relationship with a very successful operator that's been based in Dallas for quite a while. And he was a big partner on our pest control business we were invested in outside of Dallas. But we've really been able to work with him to build relationships. And it's been sort of a slow, years-long effort of finding ways to get involved in the deal-making community and the M&A and advisory community, and building on and leveraging our reputation that the family's had for a decade and a half now, investing in companies. So it's been a bit of a process, but thankfully the last year or two, we're starting to see some real fruit.
That's great. It's great to hear. And Maggie, you've touched the family office space from a wide variety of angles, working in family-owned businesses, building out a family office practice at MCG, now Baker Tilly, and then now in your role as a partner with your own group. Can you tell me a little bit just about how those different roles have felt different, have been different over the iterations?
Yes. So probably my favorite part, there are many favorite parts about founding and managing the family office practice for MCG, now Baker Tilly. What I loved there was helping principals, owners, the heads of family offices decide what private equity focus they would do. They would have their buckets at Goldman, Merrill Lynch, name their places, and they would get pitched a lot of interesting things. And that was part of understanding not only their expectations. It's easy for me I have my master's in accounting, so I have that brain to evaluate if it was a good company, but with something that could be successful, but more importantly, whether this would fit their expectations. And a lot of times, so many attorneys here, it's reading between the lines. What people will tell you they want is very different than what they tell you they want, and knowing that behavior and their choices. And so that was a lot of fun. Being in-house for so long with many privately owned operating businesses, and then helping them with their investments, particularly in private equity. It's really fun to do that now for many family offices. And it's we're doing what I did, my favorite part of my family office job, now with many families. And that's just, it's really neat. You're working with passionate operators on the company side and people who are really passionate and interesting and intelligent on the family office side.
Great. And would love to jump into one of the main topics of the day, although we've been hearing it for a while, and that's been the COVID pandemic, the shutdowns, how that's affected deal flow and how we manage our businesses. Mickey, you talked to a lot of different families. It'd be great to hear your perspective on how your business was affected, how the businesses of the people that you work with were affected, and maybe some things that people are doing differently that have worked well or haven't worked so well.
Yeah, thanks, Mark. I would say our business, our investment banking business really, really shadowed what a lot of our clients were saying. So if you think about March, April, May, there's that initial scramble of, making sure that your business is able to work in a work from home manner, more online, less in person. And all of our clients were kind of working through those same things, making sure their balance sheets were, intact, making sure their businesses and their people were safe. And then once you got over that initial rush, as you saw the equity markets sort of rebound in sort of mid to late summer, our business did as well as we continue to do. So we did some more public offering work. And then, post Labor Day, the M&A market and the capital raise market really heated up, and both for us and then obviously for our clients in the market in general. And I think there were a few drivers to that. One, folks understood what was in their portfolio and where the issues were and how to handle those, or also surprisingly, some found some strength in their portfolios in unexpected places, businesses that were able to change to meet the demands of COVID. And so you saw a lot of sellers and people raising capital for perhaps the next wave for, tax purposes with the election. And you had a lot of deal flow. We had a record December, for instance, in 2020, which was a surprise. So all in, we actually ended up above budget at Stephens in our investment banking revenue, whereas April or May, I probably wouldn't have expected, that to be the case. And I think the same was true for deal flow in general. There was more deal flow than people would have thought in the summer. And I think the way that folks get deals done has definitely changed. There's more Zoom calls for introductory management presentations, things like that, which in many ways is much more efficient, and folks are, finding ways to do due diligence without getting on an airplane. And the way that's translated into this year and kind of the forward look is there's still a lot of capital out there on the sidelines, and still a lot of deals that need to be done. And so we're as busy as we've been in years in M&A. And I would tell you, we had 3 or 4 conversations yesterday with family offices that said the same thing. They're as busy as they've been in years because people have begun to understand how to, accomplish an investment, do their due diligence, meet new opportunities, and get their work done in an unusual, historically unusual manner. So the deals are going to happen. The capital's there, and the market is rolling again, especially for companies that, were able to perform and persevere through COVID.
And I can kind of attest to that. We also saw that kind of dichotomy between the beginning when nobody knew what was happening and we didn't know where all the risks were going to be in the portfolios, and kind of to a surprise for us after Labor Day, as you mentioned, it seemed like the deal flow really picked up for us. We were very active, we're able to get some things done, and then a lot of the operating businesses had record-breaking years, kind of like you had mentioned on the investment banking side. Adam, from your perspective on the deals that you guys are looking at and that you're managing, how was that experience for you guys?
Yeah, it was pretty similar to what you guys both just laid out. I mean, the first 3 months, we sort of pivoted. Our investment team is 9 professionals, and we had Zoom calls every morning to touch base on the portfolio, individual companies. And those first 2 months were really geared toward, we invest in a lot of services businesses, primarily need-based services businesses, with human capital labor forces. So those were focused around how are we changing our business and our operational models to keep people safe, to not have people exposed. And then what does the next 3 months look like? What's our liquidity situation? Do we need to be prepared to support any business if there's some sort of extreme short-term liquidity problem? So as every portfolio does, we had, a couple hiccups and a couple select businesses struggle, but overall, it worked out pretty well. Everything was pretty resilient. And, by the end of the summer and the fall, things were really starting to come back. And we had some residential, some home services businesses that performed extremely well because people were always at home, interacting with technicians, able to have a more positive interaction and reinforce that. But, it was really focused on the existing portfolio and making sure everything was performing well and was going to get through. On the deal side, we actually closed a new deal. It was a smaller investment. It was an all equity deal. We closed a new deal the last week of March. So that was, there was some decision making to go ahead and go through with that, but we did, and it's turned out well. Not a whole lot of new deal activity in the spring and early summer. I'd say once we got to the back end of the summer, we started re-engaging with some of the companies and groups we went on pause with when COVID happened. And then, as Mickey said, toward the fall and the winter, the activity has just exploded, and we've been incredibly busy.
And you mentioned something interesting there about how the deal that you guys did was an all equity deal. One of the things I know we as a panel have talked about, and we talk about a lot in the family office space, is just how there's really not a box you can fit a family office into. They're all very different. Is that normal when you guys look at financing a deal to do all equity, or how do you typically look at structuring a deal from that perspective?
Yeah, one of the real advantages of being in a family office and having a really flexible capital base is there's a lot of different ways you can structure these investments. So our firm as a whole, we focus on control majority buyouts. Typically, it'll have some form of leverage. It'll be a lower leverage multiple than you'll hear from a lot of typical private equity firms today. That's just not how we earn our returns. We've done a fair amount with the independent sponsor community. We've done minority investments where we'll just put money on the balance sheet to do add-on acquisitions. And we've done all equity deals in smaller opportunities that may not be the right time yet for financing. So the one we did in March, it was a software business, part of our software platform, and it wasn't really a leverageable deal at that time, but it was still an exciting investment for us, and we were able to fund it with all equity.
That's great. And when you are working with independent sponsors, as you mentioned, do you guys often team up with other groups who could be maybe anchoring the deal? Do you look to anchor it yourself or potentially be the only source of capital in those kinds of transactions?
Yeah, all of the above. We,
okay.
In particular, our relationship in Dallas, we got a really strong relationship with an independent sponsor. And those, we are the sole capital source. And we're getting involved maybe at an earlier stage than you would typically think of with independent sponsors. We're getting involved at the pre-LOI stage. We're pretty heavily involved with the due diligence, with a lot of the business diligence and the third-party due diligence. But we've also got a couple other investments in our portfolio with different independent sponsors where we are one of several investors or one of several family offices where we're not involved and we don't have the level of control. So it's really, it's about flexibility and it's about finding good opportunity. So it's kind of all the above.
Great. And Maggie, with MJ Capital Consulting, as well as the people that you talk with in your network, what have you guys experienced as a firm, and what are you seeing with the people that you work with?
So what we're seeing now is a huge amount of optimism and excitement. It's, March, April, May, June, kind of lingering into the summer. We saw that a lot of families were taking this opportunity, really, they saw to kind of reset and evaluate everything they were looking at. The great news is we've been able to have in-person events outside, limited number, we used to have very large events, 50 to 70 people. Now we're having, 10 people together outside. And that really gives people a chance to talk. A lot of our families will bring other families in to co-invest. They'll find something, they'll do a pass off. And, they're really evaluating the management team and the exits of these companies. And so we always start with the exit in mind and get on the cap table with the company we're working with that could be a likely buyer. But we've seen just a lot of excitement about kind of being out. And again, these small group synergies that are really nice. But I think things are, we're incredibly busy and just, again, see a lot of excitement since March through June, July, were really dead.
Mm-hmm. And Mickey, come back to you briefly on this topic. I know you guys work with people all over the country. It sounds like more of a regional focus, but kind of all across the board in terms of the groups of people that you're working with. Do you see things different? Are the perspectives you're hearing from the families that you work with different dependent on the cities that they're in, and how does that differ?
We are, so we're industry focused, and we kind of go, so we'll be across the country. We'll go where our industries take us. I haven't noticed, I would say, a regional flavor for how families are thinking about or have thought about the various points in this environment. Well, with one caveat, I think, New York-based folks are typically not in New York right now. They're in the Hamptons, or they're in Florida, or they're moving to Florida, which is, increasingly a trend. I would tell you 2 years ago, if you looked at the heat map where our family office relationships were, 25-30% were in New York City. Increasingly, that heat is draining down to South Florida. And so, there's a much bigger density down there as folks move to that jurisdiction, for a number of reasons, probably exacerbated by COVID and the population density in New York. So yeah, I think that's been the main trend I've seen come from this in terms of geographic driven, reactions. Otherwise, I think it's been more about, how do we think about investing in uncertainty? How, as Maggie said, there's a ton of optimism, and a lot of folks, who have a value sort of, orientation, have a hard time with that, right? They have a hard time seeing, where the optimism's coming from, and how do I deploy capital into that? Do I just stay with dry powder, or do I, sort of forge ahead, and this is the new normal? And so there's a lot of questions, a lot of uncertainty, and, which we think creates a lot of opportunity for our clients and for partnership.
And that's a good segue into our next topic on more of the macro economic themes and concerns that we're currently seeing. The last 12 months saw a record amount of stimulus, both on the monetary and the fiscal side, coming into the economy. And in recent market activity over the last few weeks, we've seen a lot of volatility in interest rates and concerns around inflation. Mickey, with the people that you're talking to, are they worried about inflation? Are there other concerns that are on their mind, given the current environment that we're in?
Taxes and inflation. I mean, that's always the concern. It has been for 10 plus years now. But certainly, yeah, taxes. I think we'll see a lot of tax-driven selling this year again. I think those who could get out the door last year, trying to read the tea leaves on the election, went ahead and took gains while they could in a low tax rate environment. And, we're seeing our pipeline sort of develop and more folks trying to get liquidity today versus, 2022. And then inflation has been the concern for a really long time. It hasn't materialized really, but it seems like it's going to happen at some point, and a lot of folks are trying to figure out how to position around it. I would say the other market trend, just from rates being where they are, that that we're seeing that's not exactly the question that you asked, but it's somewhat related, is the emergence of SPACs in the capital markets as a buyer of private businesses, a way to go public for many of the technology companies that Maggie's interacting with. And then even, really solid sort of $1 billion to $4 billion, $5 billion companies. There are some really nice valuations in capital that has, a time limit to it. Much of that market has been driven by, the low interest rate environments that have been sustained. It's a technical, thing, but a lot of hedge funds use the SPAC market as a way to park cash and earn a little bit of return versus the low, no interest rates they can get on their cash balances. And so that has been an offshoot, I think, of the broader, macro trends that folks are concerned about. And, it's just more competition in our minds, for really nice assets out there.
Absolutely. And I'm glad you brought that up, because the SPAC boom has been an interesting thing to watch. It's not necessarily a new structure, but it has definitely picked up a lot of steam over the last year. I know we had portfolio investments that began exploring SPAC options when they had previously looked at just doing a traditional IPO. And many of the people that I talk to in the space are looking at raising money for SPACs. I'm curious, staying on the inflation topic, but also opened up to the SPACs or anything else that you're seeing. Coming back to you, Maggie, what are kind of your thoughts on some of the macroeconomic trends, inflation, and some of these other things that Mickey's mentioned that we've been seeing in the market?
Again, and yeah, Mickey hit on this. I'd say the election and the new administration, that has had probably a larger impact even than COVID on most of the families we work with, and just the uncertainty there and how to get ahead. I'll say with growth equity, where you have a 2 to 5 year hold on most of the things we work with, whether those go SPAC, which is really interesting. We are working with a SPAC group very, very cautiously. They've had a lot of success. It's a controversial subject, but one of the most traditional family offices we work with, who incredibly just, they expect pretty low, safe returns. They really pushed us to get involved with a SPAC operator, and a man who's now doing his 4th SPAC fundraising. And originally we were working on that anchor capital. Well, he made 3 calls and it was full on the anchor side. And so in SPACs, what we keep hearing is the farther down the line you are. So if you're closing out the SPAC, the economics of a family or an investor is going to ask for are going to be huge. So it's an interesting, with SPACs, timing is a huge, huge part of it. Whether you get in really early as the anchor, or whether you want to kind of ride that risk and get in to fill the last part and take just much better economics. I don't know, SPACs, kind of a wait and see. They're on everybody's mind. The New York Times had a really interesting article, more on the social side, but does every celebrity have a SPAC now? So that this was in the Sunday New York Times, kind of made me think this may have jumped the shark a little bit when AZ promoting SPACs. But again, we're seeing a lot of optimism. We have, our families we work with, we've got kind of the young, more forward-looking that like growth equity, and we've got a lot of traditional ones. And again, I had an interesting situation Monday with a traditional family office that's been incredibly safe. It's oil and gas family, interested in jumping into the SPAC game. So it'll be interesting to see how this moves along.
Absolutely. And Adam, from your perspective, what kind of, have you guys been following some of the same macroeconomic trends, and do you guys have concerns around inflation, or what are your thoughts on the SPAC topic that we've been discussing?
Yeah, I'd echo that. SPACs may have gotten a little overheated. It's not something that we are spending a lot of time evaluating or really interested in. Inflation is, it is on our minds. We're not really sure what it's going to look like. We say the word unprecedented a lot right now, a lot in the last 12 months. But it has, it's just made the market so competitive. The leverage markets, the debt pricing. I think I saw the Bain Capital report came out this week that said the average leverage multiple is 7x. It's just crazy, and it's made it that much more competitive, and that much more difficult to get deals done. Taxes as well. I mean, there was a huge rush at the end of last year. I mean, it was almost a double whammy. You had the markets coming back from COVID post Labor Day. Anybody that had a business that had performed at all was ready to get back to the market because there was no COVID discount. And everyone wanted to get back to the market, and everyone also wanted to sell before potential tax changes in 2021. No one can predict the future or the politicians' minds. It's looking like now whatever tax increase there might be could either be at the end of this year or later this year, as opposed to certainty that it would be retroactive to January 1st. So we think you're going to see a lot more for the rest of the year, a lot more of the same of groups wanting to come to the market and not face that tax uncertainty. And from a macro perspective, I think Mickey mentioned some of the population movement trends. Like I said earlier, we've always tended to focus on a geographic basis, but we do look to invest really across the U.S. And even more so the last 6 to 12 months, when we look at a new opportunity or think through, it's been through the lens of what are the population growth trends here, particularly us as services companies, investors driven by population. And it's going to be that much more difficult for us to get really comfortable to invest in a company that's serving one of these areas where we just see a lot of people leaving.
Mm-hmm. And I have to imagine when you guys were looking at Dallas as a new opportunity, demographics had to play a role in that decision.
Yes.
What other kinds of things did you guys take into account? Were the regulatory environment and things like that also important to you?
Yeah, it's population and economic growth trends. It's a business friendly environment, and it was similar to when we launched in Western Florida when the family office was a lot younger in the early 2000s. Back then, Ken Hooten, one of our managing partners, called it a Southwest city. Dallas-Fort Worth is obviously much bigger than that, so a little bit different. But you're exactly right. It's the combination of growth trends that we think are going to be there over the long term, and it's a business-friendly environment.
Great. And before opening it up for questions, I'd like to briefly ask the panelists about their thoughts around any sort of future trends, and this could be some of the more longer-term opportunities or things that we're seeing. One of the things we talked about on prep calls are the volatility and interest around Bitcoin and blockchain technologies. So Adam, sticking with you, I'm curious if you have any thoughts on any of these big future trends or ideas like blockchain, Bitcoin, or anything else that you guys have your eyes on.
Yeah, there's kind of three quick things I'll hit on. First one is cryptocurrencies. We are taking a look at some kind of exposure to that asset class. It's pretty small, but it is something we want to monitor, and that's typically been through fund investments. And those funds are GPs or funds we've had decades-long relationships with, and it's a small percentage allocation. But in the last 6 months, we've invested in a couple of cryptocurrency-related funds to make sure we're involved in that. The second is, and this was pre-COVID, about a year and a half ago, we launched a Southeast Asia investing strategy. Similar to what the Staines family did in the late 90s, they first invested in funds, and then 5 to 8 years later, they started direct investing. We have started with some relationships in Southeast Asia. We've invested in a couple of funds, a venture capital fund and a more traditional buyout fund. And at the end of January, we got our first direct deal done, a pest control business based in the Philippines. So long term, when you talk about how competitive the deal market is in the U.S., and when you talk about population growth, we think there's a really large, continued long-term opportunity in Southeast Asia where we'd like to invest and get some exposure. And the third is, all of the social issues that sort of came to a head over the summer. Our two managing partners, Ken Hooten and Jen Staines, late last summer and really for the last 9 months have been really committed to helping to stand up a new fund based on supporting the Black community. And so it was really with the idea of closing the wealth gap. We found a couple of really great and experienced Black GPs. We partnered them with some really supportive family offices and investors. And it's been focused on either Black-owned businesses, Black-led businesses, or businesses that significantly sell or support the Black community. So that raised about $100 million fund that's in its final close. And it's something our whole firm and our family investors have been really excited about.
That's great. And are you guys focused on specific industries, or is it pretty opportunistic in terms of how you're looking at working with the Black community?
It's fairly opportunistic, and we're focused on, again, good GPs, a good investor base, and then getting good deal flow. So the individuals who are leading it are all very accomplished and have done a really nice job of building their own deal flow. And then, groups like us and other investors are trying to help there as well to get them as many opportunities as possible.
That's great. And Maggie, I know you look at a lot of technology growth equity. What kind of things are you looking at in the future? Are blockchain or any other technologies a part of that?
This was said by a Houston family office. They look at it as gambling, which is interesting. So we had the largest cryptocurrency bank. So that I found that very interesting. Doesn't look like we'll work with them, but I'm like, this is going really legit when you've got a cryptocurrency bank talking to us about working with them. I don't know. I can't get my head around cryptocurrency, so probably the wrong person to ask, but it's funny. We'll hear from principals. Well, I bought a few Bitcoins or blockchain, or, this is the way, they'll kind of dabble in it. And again, they kind of look at that as gambling. What we're seeing and what's exciting is this raise closed last month, but how technology can improve lives and be environmentally sustainable, improve. We worked with a company named Plant Prefab that is very high-end custom homes, but prefabricated. So the founder is a Steve Jobs protege, was on the Disney C-suite, and he's got just an incredible close to $100 million committed backlog for people with these homes that are built in Southern California primarily, that can literally be built home in any area, very high-end homes in 30 to 60 days. And it's a neat company, but what was neat is how you bring the technology side, the environmental. This is great for the environment. And again, this raise was to build 2 more plants so they can expand into more of this area, because right now they're just in California. So it's exciting to see how technology and how we can do things better and improve lives, and just exciting things out there.
And Mickey, from your perspective, what kind of future trends are the people you're talking to looking at, and is it are blockchain or things like that, are they involved in that conversation?
I think blockchain and cryptocurrencies, it's Maggie used the term dabble. I hear it's more kind of news flow driven, individual driven. We do have some groups that are, thinking about their business models in the light of, how do you address blockchain or use blockchain, as a mode of business to, compete in the future. But we don't, I would say the conversations we have, less than 1% are about investing in cryptocurrencies today. One trend that I think it's not, emerging, I think it's it's definitely set is just ESG investing and, regulations around, where the private equity in particular and public companies can invest dollars, and which has created a bit of a vacuum in certain industries, which is the intended consequence, right? But it certainly has created, again, for lack of a better word, a vacuum in industries like firearms, for instance, or the energy markets, or places where capital can't go because it triggers an ESG concern. And so we see where there's lack of capital or lack of demand creates opportunity for return in some areas that for folks that can be more flexible around how they deploy their capital, which is family offices to a T.
Mm-hmm. And one of the interesting things I find about the ESG focus is it does combine three different components into that. You've got environmental sustainability and governance. Do you see people focusing on one or two of those things, or is it typically looking at all of those comprehensively?
Yeah, and I would say it's used a bit of as a term of art in the private markets, right? I would say on sustainability and environmental, much more than governance in the private markets, and it's a lot of folks that we interact with that built their net worth, in oil and gas, for instance, looking for ways to diversify into renewables or other sustainable energy alternatives. But it's also, again, as a term of art, used to mean the things that you don't invest in because of some dynamic in the industry. So I think in the private markets, it probably has a little bit in our minds a little different sort of usage, if you will, and sort of how people assess where they're putting their money.
So is it fair to say it's pretty closely tied with impact investing from the viewpoint of a lot of the clients?
Yeah, I think it's not exactly the same thing, but it's the same chord, right? I think it's all sort of interrelated, and and we do, I would say, with this generation, kind of the younger generation of families moving in G2, G3, you do see much more, social impact, ESG concerns, wanting to really, wanting to make their dollars, fill not just a return threshold, but also some other, cover some other bases for the family.
Great. Well, I appreciate that, guys, and lady, and we've got a few minutes, went a little bit over, but let's see if we can get some, if we have any questions here in the chat. All right, so from Jill Lewis, there is a question. There seems to be a lot of capital chasing a smaller number of deals. Where have members of the panel found success identifying quality deals? Adam, I'd like to start with you on that one, because you mentioned something along these lines about how the multiples have gotten high and gotten a lot more competitive. So do you have any thoughts around that question?
Yeah, it's sort of reinforced our strategy for a while, which is, we can look selectively in competitive auction processes, especially in industries and company types where we have a really good background and experience, and we can really create value. But it's made it that much more important to find companies that are really looking for a partner. Most of what we do, I don't know that we've ever invested in a company that was previously owned by a financial sponsor. It's all first time outside capital. It's all an entrepreneur, a family business that wants someone to help them grow. Either they're younger and they want a value added partner, or they're getting close to retirement age. They want to transition to a chairman of the board or board of directors role, and they want someone to help them find and recruit the next level of management talent. And, look, they're very much fair valuations that everyone's comfortable with, but in a process, in normal times, let alone today, that's really efficiently run and really competitive, where we don't have a strong angle, it's essentially impossible, or it has been impossible for the last 9 months. So we've had to be a lot more targeted. We've had to be a lot more relationship focused.
And Mickey, coming back to you, do you also see people focusing more on the lower middle market or on some of these, avoiding the financial sponsors to find opportunities as well? And what have you been seeing around the competition?
Well, I think Adam, it was good that you went to Adam first because they're as good as it gets in this area. I think it is a very competitive market, and you have to, to really, I think, deliver, make strong investments and to deliver returns. You really have to have a right to win, and that right could be an industry specialty, right? So we see more groups sticking really close to their knitting and getting really deep in a vertical and just doing what they're good at. It may be a partnership specialty. There's groups out there who are really strong in terms of structuring and helping an entrepreneur find, an outcome in the capital structure that, sort of hits all the things that they need to hit for a partner. And like Adam said, fit is as good as there is when you're a business owner and you care where the business lands, or you're going to stay in it and you're just looking for a partner. The fit of partnership is probably the most important thing. I think we would probably all agree. And so those things are, kind of picking your battles. And I'd say the family office world, the flexibility to be collaborative. We see a lot of families that stick to their knitting where they can and partner where they can to find more deal flow, to bring in expertise, to do due diligence and manage an asset. So I guess I agree with Adam is what I'm telling you.
Great, thank you. And Maggie, and from your perspective, how has the capital, the increased amounts of capital all out there looking for deals affected your business?
Well, what's interesting is on the deal side and the company side, they don't just want capital. They want, and this is so overused, but they want strategic capital and a capital partner who can really help them grow, make introductions, really grow their business. And that's just critical. We have companies that'll say, no, we don't want that. We want, they're getting very specific when it's a good deal and a well-run company. That's the company I referenced, Plant Prefab. Amazon was an early investor, or Series A, and this was just a Series B. They said, Amazon will probably buy us, but we want other people on our cap table. We want you all because we don't want to be left with that only option. So, it's really the expectations on the companies raising capital have increased quite a bit, where it used to be the capital calling the shots. And again, living with that. Now it's really the quality of the money, not, you need money, but it's the quality and the way you can work together. And again, the relationship side and seeing that they're really going to work collaboratively. We have families who say, we only want to control interest. We're going to buy this, control this. But we have many who are happy to be passive in certain things. But even if they're passive capital, they're expected to help in very specific ways, which I find interesting and wonderful as well.
You bring up a really interesting point, and that's something that has, while it doesn't always benefit, we oftentimes find that it benefits us, that perspective, because a lot of the people we talk to, they'll go through a traditional investment banking process, or they'll talk to financial investors, and they often like the flexibility that can come with a family office, or having somebody that can be more strategically focused rather than just looking for a buy and flip type of opportunity. Great, and so I think we've got time for one more question. This one is from Michael Johnson. During early 2020, we saw a reticence to invest without in-person meetings with management teams. How have you worked around this limitation? And just kind of keeping the order going, Adam, we'll start with you. Did you have any thoughts on that question?
Yeah, so the deal we closed right when the pandemic started was local, and we had met face to face many times with that management team. So that one probably wasn't applicable. But I'd say absolutely, particularly with our software platform, about the only new deals we saw in April and May were software companies because those were still resilient, and everyone was already able to work from home anyway. But it was essentially, if we can't at some point get in front of the team and meet the team and form a more personal connection with them, it's just going to be very challenging for us to do. So as the year went on, we were able to meet again, particularly pick up companies and conversations we had already been talking with pre-pandemic. So that was a little bit easier. But I'd say very much so, particularly because we're focused on partnership. It's very difficult for us to invest without meeting a team in person. But then, of course, I say that, and then I turn around, we make rules to break them. The business we invested in the Philippines, we did not go over and meet them in person. That was all through Zoom. All of our due diligence was electronic and remote. So travel was a little bit more difficult there. But outside of that scenario, across the world, in the US, we needed to have a meeting to really give the final approval.
And Mickey, from your perspective, are people doing things differently to get comfortable with a lack of in-person meetings, or are you seeing that those in-person meetings are continuing? What's been your view?
In-person meetings are still continuing. There's just less of them. I mean, there's much more being done, initial meetings, management presentations, all being done, virtually. And then, making the world move, moving heaven and earth to get in person, whether that's, chartering a plane, making a really long drive. We've seen a few of those. And so I do think the in-person, there's just that box you got to check on, 99% of deals to be in person. And so, it's still happening, but just not the number of meetings in person that you would have had kind of before COVID.
Great. And Maggie, from your perspective, what have you been doing to get around the limitations, and what have you been seeing with some of the people you work with?
What we've seen, so most of our companies we're fundraising for outside of Texas, but again, it's, understanding the deal, teeing it up and having an initial Zoom or webinar kind of meeting. And then we get them here, and they have really loved being in town, and it's been pretty neat. The novelty of being together in a small, safe, generally outdoor environment has been really good. And there's something about the being together. We hosted an event Tuesday evening for a group that's from out of town. And we had people coming into the event, other family offices coming in and saying, well, let me introduce you to this person. And here's a perfect, it's been really fun. And we have a New York co-investment family office that's been here probably every other week. We're really lucky to be in Texas where we're open for business. We've had LA, we have some Mexico, very large Mexico City family, and they're all living in the States. And it's like people come here and they get to be around each other and really, work and kind of see eye to eye. And we're really thankful we can do that safely here.
Absolutely. Well, I want to say thank you to everybody on the panel. I really appreciate the conversation and y'all taking the time to come here and provide your perspective. And then also thank you again to all of our sponsors for the conversation. And with that, I'd like to turn it back over to you, Daniel.
Awesome. Thanks, Mark. Really appreciate that. And once again, thank you all for such a great panel. We very much appreciate your time and insights. I know we all realize the value you have provided today. We are all looking forward to a much better year. Now, we hope that you all stay on for the networking portion now. If you've turned off your video earlier, we ask that you turn it back on, and we're sorting you into breakout rooms right now. We'll have 2 rounds of networking, and you'll be randomly sorted into these groups.